Good morning. Wishing you a wonderful Monday and a great week ahead. Welcome to today's episode of Morning Wealth. We'll talk about three things. Visa under investigation, US banks down on SLR, and the week ahead. Declines in financial stocks pulled the Dow Jones lower on Friday. All three major indexes ended the week in the red. The Dow was down 0.7%, the S&P 500 was down 0.1%, the Nasdaq was up 0.8%. All the indexes posted weekly losses of less than 1%. The yield on the 10-year Treasury edged slightly lower to 1.729 after ending Thursday at 1.73, which was the highest since Jan 2020. The major news on Friday was that of Visa. The Justice Department is investigating whether Visa is engaging in anti-competitive practices in the debit card market, a probe that casts a cloud over a core part of its business. The department's antitrust division has been gathering information and asking whether Visa, the largest US card network, has limited merchants' ability to route debit card transactions over card networks that are often less expensive. Many of the department's questions have focused on online debit card transactions, but investigators have asked about in-store issues as well. The probe highlights the important role of so-called network fees that are invisible to consumers and lucrative for card companies, but weigh on merchants who often pass on the fees in the form of higher prices to consumers. How debit card transactions are routed is a long-standing point of contention between merchants and card companies. The Durbin Amendment, a part of the 2010 Dodd-Frank Act, requires the merchants have the ability to choose from at least two unaffiliated debit card networks to route transactions. Merchants have for years alleged that they are often unable to route online debit card purchases over smaller networks such as Shazam or NYCE when Visa or MasterCard's name is on the front of a card. The merchants say that as a result, they often end up paying higher network fees compared to what they could pay to lesser known networks. The Justice Department is seeking information about the financial incentives that Visa provides to banks that issue cards on its network. This is also what is getting reported on the Wall Street Journal. It is looking at whether those incentives encourage banks to not enable routing on other networks. Sticking with banks, a year-long reprieve for Wall Street is coming to an end. The Federal Reserve said Friday that it wouldn't extend the emergency relief that eased the capital requirements for big banks during the pandemic, putting pressure on bank stocks. The reprieve temporarily excluded one-year treasuries and deposits held at the central bank from banks' supplementary leverage ratio calculation. That allows banks to replace their stockpiles of cash and US government debt and other safe assets in the asset pool with loans to cash-strapped consumers and businesses. What is the ratio? The ratio basically measures capital as a percentage of loans and other assets. Without the exclusion, treasuries and deposits count as assets. That will likely force banks to hold more capital or reduce the holding of those assets, both of which could ripple through markets. A note here, big US banks must maintain capital to at least 3% of all of their assets, including loans, investments, and real estate. By holding banks to a minimum ratio, regulators effectively restrict them from making too many loans without increasing their capital levels to recover potential losses. The banks, on the other hand, are sitting on giant stockpiles of cash, US government debt, and other safe assets. By tweaking how the ratio is calculated last year, the Fed was effectively trying to engineer a swap, remove treasuries and central bank deposits from the calculation. The thinking went that banks should be able to replace them in the asset pool with loans to consumers and businesses. Banks had pressed for an extension, saying that without it, they might pull back significantly from treasury purchases. JP Morgan was down 1.6%, Bank of America was down 1.1%, while Citi was down 1.1%. A quick mention about FedEx before we speak about the week ahead. Last month's US winter storms didn't stop FedEx from delivering a profit. The package giant reported Thursday that profit nearly tripled in the last quarter and revenue rose 23% despite significant delays from the winter freeze that disrupted its delivery operations and sapped its profit by about 350 million. FedEx, like its competitor UPS, has been handling a surge in e-commerce orders during the pandemic as more people shop from home, and FedEx executives said they expect that trend to continue even as COVID-19 vaccines roll out. FedEx shares were up 6.1% on Friday. On the week ahead, Jerome Powell and Janet Yellen testify Tuesday and Wednesday on US stimulus and pandemic policies. The Fed chief has few reasons to deviate from the recent comments, but Yellen may be pushed to weigh in on specific tax, spending policies and proposals. It's also a mammoth week for Fed speak with at least a dozen different officials on tap. The central bank's favored inflation gauge is also due on Friday. Treasuries face another trying week with a slate of auctions focused on maturities that have gotten beaten. A key source of stress may be the sale of the 62 billion 7-year notes on Thursday. It was a disastrous offering of such notes in February that sent bond markets into a tailspin. On the earnings front, we'll be looking out for meme stock GameStop is the highlight. Adobe, General Mills is also something that we'll be looking out for. In terms of top Chinese names, Tencent, Xiaomi, PetroChina, Sinopec and Sinopec are the names that we'll be looking out for. That's the update. Stay safe and healthy, and I'll speak to you tomorrow.